Ever wondered how some wealthy crypto investors sell their coins and somehow stay completely calm when tax season arrives? While most of us start sweating like we just opened the wrong app by mistake, it almost feels like they know a hidden shortcut labeled "Keep More Money." But the truth is far less mysterious. There's no magic trick, no secret society, and no illegal loophole. The difference usually comes down to planning, patience, and understanding the rules before emotions take over. Most everyday investors jump into crypto thinking about profits first and consequences later. Wealthy investors often do the opposite. Before they even buy, they quietly ask themselves, if this grows, how will I sell it smartly? That single question changes everything. It's like going on a vacation with a return ticket already booked, instead of hoping flights will be cheap later. Planning the exit before the entry may not sound exciting, but it prevents panic decisions. One of the most common strategies is simply not selling everything at once. It sounds obvious, but many people ignore it. Imagine you baked a cake for the week and ate the entire thing in one night. It might feel great for 10 minutes, but regret arrives quickly. Selling all crypto in a single transaction can sometimes push someone into a higher tax bracket, which means paying a larger percentage in taxes. By spreading sales over time, investors may keep their tax rate lower and maintain more control. It's less dramatic than a big splash sale, but often more efficient. Another approach often discussed is tax loss balancing. The name sounds technical, but the idea is straightforward. If one investment gains value while another loses value, the loss can sometimes reduce the taxable impact of the gain. Think of it like balancing a monthly budget. If you overspend one week, you naturally spend less the next to even things out. In investing, this balancing act can legally soften the tax hit without doing anything shady or risky. Then there's the power of long-term holding. This is the strategy nobody brags about because it's slow and quiet. In many systems, assets held for longer periods may qualify for lower tax rates compared to rapid buying and selling. It's like planting a fruit tree instead of buying fruit every day. You wait longer at first, but the rewards continue over time. Wealthy investors often accept that patience can outperform constant activity, even though patience rarely trends on social media. Some investors also consider donating appreciated crypto directly to charities instead of selling it first. By transferring the asset itself, they may support a cause they believe in, while potentially receiving tax benefits. It's one of those rare financial moves where generosity and strategy align. And honestly, it feels much better to see your gains helping something meaningful than watching them disappear into unexpected expenses. Another quiet advantage wealthy investors have is professional guidance. Accountants and tax advisors are not just for giant corporations or celebrities. They're essentially translators for complicated financial languages. Trying to decode tax rules alone can feel like assembling furniture without instructions. Possible, but stressful and time-consuming. A good advisor doesn't eliminate taxes, but they often help avoid unnecessary mistakes. What's important to understand is that most of these strategies are about legal tax planning, not magically avoiding taxes altogether. The wealthy usually don't escape taxes, they prepare for them. They treat taxes as part of the investment journey, rather than a surprise monster hiding at the finish line. Timing, diversification, and emotional control play a bigger role than any secret trick. And here's the ironic part. None of this information is hidden. It's publicly available, but rarely discussed in everyday conversations. People love sharing profit screenshots and price predictions, yet almost nobody shares screenshots of smart planning. Quiet decisions don't trend, but they build stability. In the end, the real difference between panic and confidence isn't luck or intelligence. It's preparation. Making money is only half the game. The other half, the part that actually builds long-term wealth, is learning how to keep more of it legally and wisely. Because when the excitement fades and the numbers settle, what truly matters isn't how impressive your portfolio looked for a moment. It's how much value actually stayed with you.